Understanding what to do when you suddenly have more money is one of the behavior changes. Whether it comes from an inheritance, a raise or bonus, or some other source, the temptation can be to follow conventional financial advice or spend it on liabilities like cars or vacations at worst. Such conventional advice could include increasing your 401k contributions or continuing to live below your means. Today, we have The Basic Rules on Investing by Robert Kiyosaki, a fourth-generation Japanese-American born in Hawaii in 1947. He founded Cashflow Technologies Incorporated in 1997, a financial education firm that owns and operates the Rich Dad and Cashflow brands. He is a household name in personal finance thanks to the success of his best-selling book, Rich Dad, Poor Dad. He wrote that working a traditional 9-to-5 job will not make you wealthy. So if you're experiencing a windfall of new money, now is the time to implement the Rich Dad principle for investing. Watch this video till the end to know the investment rules by Robert Kiyosaki that you should follow. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. Investing is all about learning to evaluate risk and reward. To become a successful investor, you must first learn to assess risk and reward. Rich Father used the example of a nephew constructing a burger stand. Would it be a good investment if you had a nephew who had an idea for a burger stand and needed $25,000? No, there is far too much risk for far too little gain. That's great, Rich Dad said, but what if this nephew has been working for a major burger chain for the past 15 years, has been a vice president of every important aspect of the business, and is ready to go out on his own and build a worldwide burger chain? And what if you could buy 5% of the company for just $25,000? Is that something you'd be interested in? And of course, a sensible answer to this question is a yes. Certainly because the reward is greater for the same amount of risk. Learning and mastering the investing rules necessitates a lifetime investment in financial education. However, these fundamentals will get you started. It is entirely up to you where you go from here. Keep in mind that good deals attract money. That is absolutely true. As a new investor, one of the main concerns was how you would raise funds if you found a good deal. Rich Dad reminded us that it was our responsibility to remain focused on the opportunities in front of us and to be prepared. If you're prepared, which means you have education and experience, Rich Dad explained, and you find a good deal, the money will find you, or you will find the money. The point made by Rich Dad was getting the money was the easy part. The difficulty was finding a great deal that drew the money, which is why so many people are willing to lend money to a good investor. This is what we call OPM, or other people's money, and it's something you should learn more about. Accept the fact that the investor is the asset or liability. This might look surprising, but this is what it is. Many people think investing is risky. The reality, however, is that the investor is the one who is taking a risk. The asset or liability is the investor. He says that he has seen investors lose money when everyone else is making money. A good investor loves to trail a risky investment because that's where the real investment bargains are. Your financial knowledge can be both an asset and a liability. For example, if you have a low financial IQ but decide to invest heavily, you will make numerous mistakes that investors with a high financial IQ will exploit. To progress from being a risky or beginner investor to a good investor, you must first invest in your financial education. Start small with your investments as part of your education because nothing beats real-life experience. Learn from your mistakes and then make bigger and bigger investments. You can also improve your financial intelligence by playing games that simulate investing. Convert ordinary income into a passive income. Most people begin their careers as employees, earning a regular wage. However, the path to wealth begins with understanding other types of income and then converting your earned income as efficiently as possible into the other types of income. In a nutshell, Rich Dad said, that's all an investor is supposed to do. It's as simple as it gets. This is why when someone receives a raise, he does not advise them to put it in a 401k or to live below their means, which essentially means saving. Rather, he advises them to pay themselves first and then invest the remaining funds in cash-flowing assets. So in a nutshell, turn your pay raise into passive income. The simplest way to accomplish this is to make your investment an expense and make it your most important expense. But before you convert your income to passive income, make sure to know your income type. And for that, let's move ahead to the next rule. You must know what kind of income you're working for. Most people only consider making money at a good job. They are unaware that there are various types of income. Robert and Rich Dad taught people for years that there are 3 types of income. First is the normal earned income. Most people envision this type of income when they consider earning money. This is the salary of the working class. It is typically obtained through a paycheck from a job. It's the most taxed income and thus the most difficult to build wealth with because the government deducts money from your paycheck before you even get it, and you're exchanging time for money. Your earning capacity is determined by how long you can work. Earned income is the income over which you have the least control. It is determined by your employer and can be reduced or eliminated. And if you want to make more money, you must either find work or hope that your employer decides to raise your pay. The second is the income built from a portfolio. Most high-paid employees also have some form of portfolio income, usually in the form of a 401k, and various paper assets managed by a financial advisor, such as mutual funds. Paper assets such as stocks, bonds, and mutual funds are commonly used to generate portfolio income. It is the second highest taxed income, and due to low returns, it is moderately difficult to build a wealth with. Over a long period of investing, most experts predict that your portfolio income will return around 7% per year, but of course there will be significant ups and downs during that time. A 7% return may seem like a lot to some with little financial intelligence, but the wealthy would reject an investment strategy that only promised much. You have little control over your portfolio income, just as you do over your earned income. You are at the mercy of the stock market's up and downs, as well as the skill of your advisor. The third type of income is passive income. People with a high financial IQ have a strategy for generating passive income. Real estate, royalties, and business distributions are common passive income sources. Rent from a property is an example of passive income. His books earn him royalties. They are cash-flowing investments that generate passive income. Passive income can also be generated if you own a business that distributes profits. In other words, it is money that comes to you whether you work or not. As a result, it is the least taxed income, with numerous tax benefits, and it is the simplest income to build wealth with due to its combination of low taxes and potentially infinite returns. Rich Dad said, if you want to be rich, work for passive income. So the same goes for you. If you want to be rich, work to attain passive income, not the normal or portfolio income. Besides anything, the first and the most important thing is to make sure to adjust your money mindset. In his book, Rich Dad's Guide to Investing, What the Rich Invest and That the Poor and Middle Class Do Not, Robert had discussed this topic. He discusses the significance of shifting your mindset from that of the poor and middle class to that of the wealthy. The poor and the middle classes teach their children to go to school, get a job, work hard, and save money. That will make you wealth. Meanwhile, the wealthy teach their children to learn how money works, create good jobs, have money, work hard for you, and invest in cash-flowing assets. That will make you wealthy. One of the fundamental misconceptions of the poor and middle classes is that you can get rich by working for a salary. However, this is extremely difficult to achieve due to how the tax code is structured. Because the government deducts taxes from an employee's paycheck before they even see it. They are always at a disadvantage when it comes to business and investing compared to a business owner. Why? Pre-tax investments are available to business owners. This gives them more money to work with. and reduces their total taxable income, which means they frequently pay fewer taxes than the poor and middle class. This is a wealthy mindset. It also explains why so many poor and middle class people were outraged during the presidential election when they learned that Donald Trump paid no taxes. They simply do not understand how money works or how the wealthy function. To be wealthy, you must change your attitude toward money and investment. This is it. Let us know your views in the comments below.